Greetings, good morning. Tony Virtue speaking, and welcome to our regular newsletter. And what interesting how much happens in such a short time in Australia these days, and obviously the main point being the change in Prime Minister, change in the cabinet just recently announced. I think business will be certainly looking for stability, certainty, and a longer-term view on business. I think the real challenge at the moment has been that many businesses really having to run effectively two business plans depending on who's going to get elected. A 3-year period for federal elections is a short period of time relative to other countries, and as such that makes a challenge. So let's see how they go. But certainly with $2 trillion sitting in the superannuation bucket at the moment, plenty of capital, if I can say, for investing in the innovative ideas that we should be developing now, particularly in healthcare, in medicine, in science, etc., there. So let's see if we can get our capital allocation a little bit better, and that will be good for all concerned. Turning quickly to America, well, the US, they squibbed it again, 9 years and a bit, and we're still at effectively zero interest rates. So look, obviously moving parts there, but look, on balance, I think a small increase, even if it was 1/8 of 1%, would have given some confidence to business. At the end of the day, if you can't make money with interest rates at that low, you really shouldn't be in business. So probably sending the wrong message if we really have to have zero interest rates for much longer. Part of the reason for that is, of course, to get your own exchange rate down to help your exports. So that's a zero-sum game for everybody. So in theory, the major countries will all have to lift their rates at the same time so they don't lose out themselves. But has spooked the market a little bit, and let's see if that gets a bit of a Christmas Santa run now. China, well, they basically stopped the futures market, which stopped the arbitrage, which brought some stability over there. Still quite a big arbitrage, though, between the same shares listed in Hong Kong, which are relatively cheap, and the same shares in Shanghai, which are more expensive, primarily because the Chinese on the mainland can only invest in Shanghai. So you'd expect that arbitrage to condense over time. And it's an enormous economy, so try to look beyond the immediate. It's very, very hard to keep growing one of the largest economies in the world at 7%. We're struggling to get 2 at the moment, so let's be fairly realistic about this. If you go to the malls up in Shanghai, in Beijing, there's an awful lot of activity going on, and there's a lot of money there, so I certainly wouldn't write them off at this stage. Locally, we're through the earnings season. Probably the most interesting thing to say is that the dividend payout ratios across the index now approaching 75%. So $3 in every 4 going back to the shareholders, and with the franking credits, that's close to $1 and $1. So quite a change in investing in Australia now, where dividends are really funding income for retirees as opposed to term deposits in cash. So providing you can live with the volatility of the share market, and by that, a 20% swing in a year is not unusual historically, but over time, if you can ride that out, there normally is an equity risk premium, which reflects the share price. At the moment, shares sitting in that 5,200 level as I speak. Not overly expensive, not particularly cheap, but probably fair value. So look, that's enough for today. Let's see how we go with the new government, and good investing, and I'll see you next month. Take care, Tony.